What's up, family? Andre here, coming to you with another episode around financial hot topics. Today's episode will be about Fintech. You're probably saying, what is Fintech? Well, you probably know Fintech from the names that have been in the news lately, such as Robinhood, Affirm, as well as Kabbage. These are Fintech companies that we're going to examine how they're changing the landscape of financial services, as well as how it impacts you and your money. As usual, before we get started, please don't forget to smash that like button, hit the subscriber button, as well as the bell next to it in order to receive updated weekly content. What is Fintech? Financial technology, otherwise known as Fintech, is the use of technology services to be able to improve and automate the delivery and execution of financial services to customers. At its very core, Fintech is utilized to help businesses, consumers, and individuals manage their financial operations and their financial lives through software and algorithms used by computers and, of course, through smartphones. When Fintech emerged early in the 21st century, it was primarily designated as a back-end system technology for financial institutions. Since then, it has had a massive transformation that now is used as a frontline operation for more consumer-driven processes. Fintech now covers the gamut of industry that is now being influenced by its technology. That would include retail banking, education, fundraising, nonprofit, and investment banking. Fintech also includes the development and creation of cryptocurrencies such as Bitcoin. Recently, there was a major milestone for Bitcoin that it has now secured PayPal as a service provider that allows customers to use Bitcoin for purchases on its online platform. These are the type of headlines that are primarily promoted from Fintech, but the bread and butter of the Fintech industry is still the traditional global banking system with its multi-trillion-dollar market capitalization. In a broad sense of the word, financial technology can refer to anything from digital money to double-entry bookkeeping. But since the explosion of the smartphone and internet revolution, it is now focused in personal and commercial financing and being able to conduct normal transaction via those platforms. Fintech now describes a variety of financial activities that a person now can conduct without having to interact with another person within a financial institution. Those would include money transfers, depositing a check from your smartphone, raising money for a startup, raising money for an established business, and also managing your investments. According to a 2017 Ernst & Young Fintech Adoption Index, 1/3 of all consumers use at least 2 or more Fintech activities in their daily lives. Personally, I can't remember the last time I've actually gone to a banking branch and deposited a check. I either do that through my smartphone or through my iPad for all of my financial transactions. Many of the most celebrated and talked about, as well as significantly funded startups, are designed for the same purpose, and that is to create a disruption in the traditional financial services model by providing faster, more efficient service to an underserved segment, which is young consumers that want to have accessibility 24 hours a day, 7 days a week, compared to the traditional financial services model. Let's take, for example, the company called Affirm. Their sole goal is to cut credit card companies out of the online shopping process for consumers. They have created a shortcut that allows them to go directly to the consumer and offer immediate, secure, short-term loans for purchases. Certainly, their rates can be high, but Affirm seeks to offer consumers with poor or no credit histories at all a way to be able to secure credit and build up their credit history. Similar fashion within the mortgage industry, a company called Better Mortgage looks to completely transform the traditional mortgage process and, by the way, cutting out the traditional mortgage broker. They do this by offering a digital-only process that guarantees a verified pre-approval letter within 24 hours of a consumer applying. A company called Green Sky is looking to do the exact same thing for the home improvement lending business. They are offering a streamlined process that avoids the entrenched traditional lenders that have dominated this industry and providing promotional periods to customers where they can apply for zero interest loans for home improvement projects. In an effort to serve a segment of the population that either has no credit or poor credit history, a company called Taylor is offering microloans that utilize the smartphone as a transaction history review and be able to provide approval directly to that consumer. Taylor seeks to offer the consumer a much better option through its series of processes that offer microloans than a traditional model of having to go through a local bank or unregulated lenders, as well as microfinance institutions. Why are so many fintech companies and startups being successful in industries that have been traditionally dominated by your brick and mortar financial services companies? The reason being is the process. They have figured out a way to truncate the process that has long been established as an unpleasant and uncomfortable process for many consumers. That would be when you go and apply for a bank loan or a car loan or a mortgage loan. You typically have to go through a thorough financial review, and it could take days, if not weeks, to get it answered. By streamlining the process and being able to provide consumers with answers within 24 to 48 hours, and removing that personal interaction that can be uncomfortable and unpleasant, these companies have been able to disrupt the traditional model of financial services. Another opportunity these fintech companies have been able to seize upon is just providing context and clarity around certain financial transactions as well as processes. For example, your FICO score. Many consumers don't know what a FICO score is made up of or how it is taken into context when you apply for credit. To streamline and completely eliminate and create a new process, in steps loan originator fintech company Upstart. Their sole goal is to make the FICO score obsolete and use a whole set of new data variables to determine a consumer's creditworthiness. Their process would include employment history, education, and whether you know what your FICO score is to be able to determine your creditworthiness. Many of these fintech companies are becoming incredibly successful by serving a population that has been overlooked and ignored traditionally by financial services companies. Take, for example, the company called Lending Home. They have created a model that focuses on differences between men and women. Unfortunately, and oftentimes, women are paid at a significantly lower rate than men. They take that into account, and they also take into account that women live longer and need to have a variety and diversified financial services platform and process that looks at those differences and offers unique products and services to fit those capabilities. Until recently, financial services institutions offered a bundle of services to the consumer under one single umbrella. Those services would include traditional banking, mortgage, and investment services. What the fintech industry has been able to successfully do is unbundle those services, uniquely price each one of those services, develop a process that's more effective for each one of those services, and be able to offer that platform to the consumer. If there is one word that is apropos of what the fintech industry has done to the traditional financial services model, it would be disruption. The fintech industry has completed a major disruption to the traditional financial services model, from services such as banking, mortgage, and investment services. These offerings were traditionally bundled, as I mentioned before, that now are being offered as individual services at lower cost and a much more efficient process. Take, for example, the platform Robinhood. You may have heard of Robinhood lately because it has been in the news because during this pandemic, many investors have flocked to Robinhood and are causing a major disruption on Wall Street. Why is Robinhood creating a disruption on Wall Street? Two reasons. It has a mobile-only trading platform. You can conduct trades directly from your smartphone. You don't need to go into a branch or to get your broker on the phone to be able to execute a trade. The second reason is that they offer no fees for trades. Those two things have been the traditional model of many financial services institutions for a long period of time, and Robinhood created a disruption by coming up with a much more streamlined, cost-effective process to be able to offer to consumers. There are other peer-to-peer lending sites such as Prosper Marketplace, Lending Club, and On Deck that give the promise of significantly reduced rates through open competition. Within the business lending industry, you have companies such as Kabbage, Lendio, and Funding Circle that have now offered a streamlined process for businesses to get quick and easy access to working capital. Then there's Oscar, an online health insurance fintech startup that aims to offer health insurance at a much lower cost and a much more effective streamlined process than your traditional healthcare insurance brokers. Keep in mind, traditional financial services companies are launching a counterattack to these fintech startups. For example, Goldman Sachs launched a new platform called Marcus that will allow them to be able to compete in the fintech marketplace and have recently expanded those operations over to the United Kingdom. Many of the large financial institutions have launched countermeasures to the fintech startup companies that have been disruptive in those industries that I mentioned before. But they have to keep a number of things in mind as they launch these countermeasures. It is not a question of just throwing money at the problem and hoping that the problem goes away or corrects itself. These fintech companies have been able to build models that are much more efficient, more cost-effective, and faster at delivering services than many of the traditional brick-and-mortar financial institutions. They are going to have to change their way of corporate thinking, deployment of resources, as well as funding in order to be able to capture some of the market share that has been taken over by these fintech companies. There are several new technologies that are on the horizon that will continue to reshape many of the financial services industry's products and services. New technologies such as artificial or machine intelligence, predictive behavior analytics, and data-driven marketing are on the horizon that will completely transform the way that these companies have traditionally done business. These artificial and machine intelligence, otherwise known as learning apps, will not only learn the habits of users, but uncover those habits that they have traditionally tried to hide from the traditional financial services models. These apps will not only be able to learn those habits, they will be able to put in strategies and games that will allow the apps to change those habits and put them in a more effective category for both spending and savings type of products and services. Unfortunately, for many professionals within the financial services industry, fintech has been able to adapt the type of technology that allows for automated decision making and a replacement of many of the in-person personnel that has been used by the traditional financial services companies. Another area of improvement that the fintech industry has been very effective at curtailing and disrupting is the rampant fraud that has occurred within the financial services industry. Through the use of artificial intelligence and technology, they have been able to develop software and algorithms that analyze a consumer's transactions, and if they fall outside the norm, launch preventative countermeasures to prevent fraud and abuse. Have any doubts that the fintech industry is going anywhere? They are just getting started. In 2019, the fintech industry alone received $58 billion worth of funding. And when you add up the total aggregate value of many of the largest fintech companies within the industry, they are worth about $90 billion compared to the year before, where they were worth about $80 billion. Currently, North America has produced the most fintech startups, both within the US and Canada, with Asia in a close second behind North America. In 2019, the global fintech industry alone brought in $141 billion worth of funding. In addition to traditional banking that has been affected by fintech, here are some other areas that have been dramatically impacted and disrupted by fintech companies and startups. Blockchain technology, including Ethereum, that includes a distributed ledger technology, DLT, that uses a series of network computers but does not have a central ledger. Contracting. Smart contracting, which utilizes computers through a series of algorithms that generates contracts and sends them out to be executed between buyers and sellers. Open banking. This concept utilizes blockchain technology to provide third-party access to bank data in order to develop a series of network financial institutions that can generate applications. A perfect example of this type of concept is the all-encompassing money management firm called the Mint. Insurance. Insurtech is the combination of the word insurance and technology. Is an industry that has been created to offer streamlined services and squeeze out as much efficiency in the current insurance industry model. Regulation and compliance. RegTech, which is a combination of regulation and technology, was created to help financial services firms maintain compliance with many of the regulations that have been set forth by the regulatory bodies and agencies. Financial planning. Robo-advisors such as the company called Betterment are using algorithms to be able to dispense automated investment advice to consumers across their platform. There are currently 4 broad categories for the users of fintech services and companies. Those 4 include B2B for banks, the business clients of those banks, B2C for small businesses, and finally, consumers. In looking at the demographics of users within the fintech industry, it certainly skews toward the younger generation because typically the younger generation is much more comfortable with the technology, the accuracy of it, and can accurately describe exactly what fintech is. As you can see by much of the marketing and consumer-focused strategy around the fintech industry is geared toward the millennial generation. Most of the activities that this generation conducts, both from a personal, professional, and financial standpoint, is all done via technology of their smart mobile devices. In terms of transformation to the business world, the transformation has been monumental for the fintech industry. In the past, if a business owner needed to secure financing or working capital, they had to engage their local bank or banker to be able to secure that process. If they wanted to receive credit card payments from their consumers, they had to engage a provider to be able to do that, as well as purchase equipment that allowed that process to be able to take place. Now, with the technology, they can be able to accomplish both of those services and those activities via their mobile devices, whether that's a smartphone, iPad, or a combination of both. One of the most heavily regulated industries in the world is the financial services industry. One of the things that potentially could slow the growth of the fintech industry is the increased regulation by a multitude of governments across the globe. As technology has become more and more integrated into the financial services process, regulatory problems have significantly increased. Some of those problems are related just to the use of technology and working some of the kinks out of the system, while others are a little bit more nuanced. The nuance comes that there is such a rush by certain fintech companies to take over industries and disrupt traditional financial services models that some of the details in that process have been skipped and they're causing regulatory problems for customers. For example, the automation of certain processes and exchanging of financial data of consumers is vulnerable to attacks across multiple networks. You've seen some of the examples of many of the credit bureaus or large credit card companies that have been hacked and information has been compromised through this process. In other situations, you have the technology industry with its move at all costs, bull in the China shop culture, collides with the traditional conservative, slow as you go financial services model can have dire consequences. Take, for example, the San Francisco insurance tech startup, Zenefits. This company broke California law by allowing unlicensed brokers to sell its products and underwrite its policies. As a result, the SEC fined this firm almost $1 million, and they had to pay a fine of $7 million to the California Department of Insurance. The cryptocurrency industry is not immune to regulatory problems either. Initial coin offerings, ICOs, are a way for fundraising for startups to go directly to lay investors to raise capital. In most countries, this form of fundraising is unregulated and is a ripe opportunity for scams and frauds across the board. Many of the regulatory agencies across the world are facing a difficult dilemma when it comes to the fintech industry. Because of the variety of offerings that are being offered in the fintech industry, as well as the number of industries that it currently interacts with, it is a difficult problem for regulatory agencies to be able to come to grips with, get their arms around it, and develop a single strategy to be able to combat those problems. In the majority of cases, local and national regulatory agencies have taken the traditional financial services regulation and tried to adapt them to the fintech industry. The passing of the General Data Protection Regulation Program in Europe in 2016 was the start of creating a framework around collection of data between institutions and consumers. Japan and South Korea also have legislation and regulation on the books to be able to address some of those same issues. It remains to be seen exactly the type of framework and regulation that the United States will be able to put in place around the same process. Okay, let's recap. Financial services and technology is what is called the fintech industry. It is an integrated technology that allows financial services companies to be able to offer their products and services to their consumers over a diversified and more efficient platform. The fintech industry primarily works by taking the bundle of services and separating those and offering the services individually to customers at a much more efficient cost and faster delivery and service. Fintech funding continues to rise year over year as more dollars and more resources are coming into this industry to establish differentiating platforms. But regulatory problems across the globe abound, and regulatory agencies are grappling with the increased problems as well as the changing technology to be able to address some of those issues. And that is it. Hopefully you now have a better understanding of the fintech industry itself, the type of companies that are creating disruptive services across the board for financial services and products that you and I use on a daily basis, and how this industry can impact you and your money. Before you go, please don't forget to smash that like button, hit the subscriber button, as well as the bell next to it in order to receive updated weekly content. Thank you for tuning in.